Right, okay, let's get started here. Sorry about that. My name is Rudolph Meinhardt. I represent Jade Capital Partners for what I hope is going to be an informative and interesting presentation on managed discretionary accounts. It's always nice to put a name to a face. You can see my little mugshot there. Some background on me, obviously. It's always interesting to know who you're listening to. I'm the Business Development Manager here at Jade Capital Partners. I'm basically responsible for building new business for Jade. I look after some of our institutional accounts and basically make sure everybody's happy and they have what they need. I also look after the sales and marketing, which includes meeting and advising retail clients about the opportunities that managed discretionary accounts can offer. Now, I haven't worked in all my career in financial services. I have been involved in other industries and such as wholesale food and beverage and manufacturing and various retail businesses and projects. But throughout all my career, I have been trading, first in futures and commodities and stock indexes and pretty much FX for the last 16 years now as a full-time trader today. So I have seen a few markets and I know my way around the journey of trading presents. But anyway, that's enough about me. Let's get started with the agenda. In order to give you some insight on what we'll be covering in this presentation, we're going to be talking about a low growth world we are living in at the moment and how to invest in it. We briefly cover off on some asset classes and alternative investments. I will cover the do-it-yourself versus the professional management, and then outline MDAs and how they work and how they can work for you, of course, and finally introduce Jade Capital Partners and some of our MDA products. Also, well, if you don't mind, we'll keep any of the questions till the end, so if we can get through the information efficiently, and you just never know, I might actually even answer it along the way. Now, of course, some housekeeping here. You see our disclaimer. You've obviously seen this before. Look, it's really just to make sure that you understand that this presentation is a general advice. It doesn't take into account any of your personal circumstances or objectives, and also for you to understand that trading in leveraged products such as derivatives is considered high risk and not suitable to all investors, and you should always trade or invest with money you can afford to lose. So that's all our housekeeping details there. Here we go. Well, look, the low growth world. Look, I recently attended a conference on world economics, and it really got me thinking about what we are facing in the coming years and what we can do to invest our money as smart as we can, and most importantly, what tools we can use for this purpose. Now, let's look at the world in a macro fundamental point of view, and I will keep this very general since economics can be confusing, or possibly more, I'll get myself all confused. But basically, the period between 2009 2015 has been completely artificial. It's been, created by policies of central banks with extremely low interest rates and pumping money into the global economy by what the US Fed has called QE, or if you haven't heard the term before, quantitative easing, which is basically printing electronic money to buy government bonds. Sounds crazy, but they actually pumped almost $12 trillion into the system. And according to an economist, Satya Das, who's very popular these days, that's like buying a large 68-inch plasma screen for every plasma TV screen for every person on the planet. So the result of this has been that equity prices have gone up and property prices have gone up rapidly, and especially recently. And the problem to understand is that these prices have not been based on any fundamental increases in their value, and cheap money has had to go somewhere. So this is the central bank poker game. The bankers are thinking if you pump enough money into the system will recover, increase inflation, and increased economic activity ultimately increases the country's GDP, or gross domestic product. Now, the problem is that this has not worked. Most central banks are running out of interest rate bullets, as you might say. The ECB, or the European Central Banks, in Switzerland and recently Japan, are actually in negative interest rates. Also, Australia just joined the merry-go-round as well by lowering interest rates recently as well. So the world is looking at deflation instead of this controlled inflation and lower growth. The IMF, or the International Monetary Fund, has revised global growth downwards almost 4 times in 2015. So you can almost consider that as a strategy it's pretty much failed. So going forward seems almost silly to try to continue with the same type of strategies or more monetary policy, but this is actually what's going on. And the reason really, or this is the reason why you hear so much doom and gloom and seriously worried economists talking about the global system, basically that the global system has reached, an unsustainable level. And you have to realize an important distinction occurring, and that is to separate the real economy from what's considered to be the financial economy. Now, the financial economy on the numbers looks good, but the real economy, is looking, remarkably different. You don't hear people talking about how their wages have gone up or how easy their investments have made them money. Businesses haven't employed lots of people, and they're not spending lots of money on new projects. And so, it's a bit like the merry-go-round goes on around and around. But at some point, the music's going to have to stop. At some point, there's going to have to be some kind of reconciliation which will have to occur. And you can consider that the reconciliation would be considered one of two things. One, the real economy is lagging behind. So that means that these asset prices will actually catch up to current valuations. Interest rates and growth rates will rise and will justify these valuations. Or two, the financial asset prices will have to match the fact that we are having a reduced growth environment and lower inflation. Now, this is going to cause a correction. There's no doubt about that. Normally, these things can be a little bit bigger than anticipated. So the low growth world in this macro view, you must be considering, that these with this correction, the growth will be limited. It's here to stay, and according to most economists, this is the world that we're living in. So at least half of the global growth has been coming from emerging markets, principally China, but also others. Now, just looking at the BRICS will give you an idea. Now, you can see here, Brazil has been in recession. Russia has also been in recession. India has been doing well, but the GDP figures are well known to be a little bit concocted, so you can never really trust them. China, as we've all heard over the last few months, is clearly weakening, and South Africa has also been in recession. So since 2009, most of the growth from these countries has also been driven by debt. And a lot of that debt is actually unsustainable because they've gone into projects which are not viable, especially in places like China and Brazil. Now, inflation is here to stay because excess money, I beg your pardon, low inflation is here to stay because excess money, supply that creates the inflation has to circulate through the economy, and the banking system has to push that money out in the form of loans. Now, if everybody's already indebted, that money isn't really going anywhere fast, so it doesn't have the same multiplier effect that it used to have, or what most economists expect it to have. So you also need to have more demand than supply for money. So currently there isn't enough demand for it, since there is massive overcapacity in almost every industry. Now, China is a good example of this, as they are overinvested in most of their sectors, and hence their slowdown is so closely watched and monitored as being actually a deflationary on a global scale. Now, there is a perfect storm scenario forming with all of these stresses coming together. A financial crisis in the emerging markets with a global growth crisis, which will pull in other structural problems in each country. On top of that, as this starts to come apart, there are social, political, and geopolitical stresses underlying that like military and foreign affairs, well, they'll also have their far-reaching consequences. So, looking at that backdrop, you have to look now and say, well, over the last few years, investor expectations have been met quite consistently and constantly. But the biggest risk at the moment is that this bias to continue, and basically, if you continue with this, you believing basically that the good times are still coming or still going. At some point, the denial will have to be addressed by actually realizing that central banks don't have the tools to keep engineering what they are trying to do at the moment. And also that when investors realize this situation in earnest, there will be a moment when the market will turn quickly. Now, as usual, market delusions always move with lightning speed, and the danger today is because the world is in deeper than we were back in 2007 to 2008. And because I mentioned earlier the toolbox is virtually empty, interest rates are at record low rates. Now, 2 to 3% is usually what's required to pull an economy out of a financial crisis. But most countries have a lot of debt, and at this time we don't have the emerging markets to supplement that either. So the question that has to be raised, and hence the theme for this webinar, is how should investors allocate assets and their energies in a low growth world? Well, firstly, according to the economist again, Syed Das, your best assets is your income, and investing into your ability to earn more income per se. Now, there are three key concepts to investing. Number one is the assurance of the return of your capital. Number two is your income, and number three is your capital growth. Now, obviously, the first point is very important, being diligent about being able to get your money back when you need to, and income streams are also invaluable, and for whatever it is, just make sure that there is one. But capital growth is the one that we are interested in, and it is going to be the hardest one to achieve going forward. You have to be prepared for its volatility in this circumstance. Now, volatility itself will become an asset class because what's coming ahead in a world, statistically speaking, is full of what's called fat tails. Now, if you don't know the definition, a normal distribution has a well-known shape of a bell curve, but a fat tail is that statistical distribution phenomena which exists or exhibits the large skewness which occurs when a non-normal distribution occurs from extreme events. And that's kind of what you can see there with that yellow line there in that little picture. And that's the kind of world that's coming at us. But since the GFC in 2007 and 2008, the world has seen many extreme events, which usually comes to mind. These events, normally we consider them to be called meltdowns, thinking our natural way of thinking is that things will go down. We call them a meltdown. But there is a new norm now, and we're calling those melt-ups. Now, with those melt-ups, 2016 has already shown plenty of both meltdowns and melt-ups, especially in the FX and equity markets. And what you need to think about is how to take advantage of these in order to achieve your number 3 investment goal, which is capital growth. Now, investing in Tomorrowland is going to be very different from investing from the last 20 years. Really gone are the days of buy and hold, wait for the dividends or returns to come rolling in. This strategy will not work anymore. Another current issue that makes this volatility even more dangerous is the trading liquidity crunch that's going on currently. Fundamentally, trading volumes are falling because market making ability has been reduced. There's a number of dealers that have gone down. Regulation has increased, hence making it absolutely more difficult to hold positions. And also the willingness of taking part or taking on that risk has changed a lot since the GFC days. Now, a conservative approach would be to have a larger than normal cash allocation, choose to allocate a certain portion of funds in a risky asset in order to catch these meltdowns or melt-ups. But you will need to have greater discipline and definitely have to monitor the leverage if you use any. Now, there will be great opportunities that lie with the up volatility and the down volatility, and the coming markets are going to be very difficult markets to invest in going forward. You will also have to look deeply on what is going on, what's basically going to suit you investment-wise, and not get sucked into the crowd-following mentality of fund managers, following benchmarks and claiming it's okay. We didn't lose as much as the other guy. So these asset managers are really playing a high-risk game of musical chairs. As an investor, you'll definitely want to be on your chair well before the music stops. Now, the Australian wealth creation, we call it the short story here for now. Australian dreams of prosperity were built on a trinity of getting a good, well-paying job, a nice house, and a comfortable retirement financed by superannuation. Unfortunately, and I think most of us are starting to realise that this has now become an illusion. Australians are now members of what is being called the precariat, the interesting term I came across, the precariously employed proletariat, or the working class. So globalization's combination of offshoring and relentless technological change has reduced job security and income for all but select a few. Housing was seen as the Australian birthright, and retirement nest egg, leading to massive overinvestment in real estate. But now lower housing affordability and reliance on housing prices has really undermined this Australian prosperity sort of pillar. And as for superannuation, unrealistic expectations, poor returns, and investment losses mean that the golden years of retirement, really, funded by super, have really, they've really come and gone. So your traditional, financial plan would have you start with a basic model, including some property, maybe some cash, and we'll cover this a little bit later. But for now, the other asset classes include the bonds, your fixed income and equities, and more importantly, alternative investments. Now, this is the asset class that is most interesting for us today in regards to our third goal of investing to achieve capital growth. Most alternative investment assets are held by institutional investors or accredited high net worth individuals, and because of their complex nature, they are considered high risk for the corresponding higher expected returns. Now, some alternative investments include hedge funds, managed futures, some real estate deals, commodities, FX or foreign exchange, and other derivatives. Now, I'll quickly run through the FX market and equities in order just to put everything into context. And look, just bear with me, even if you do have some experience or expertise in some of these, we'll just go through it just to make sure that we're covering everything on. So in the foreign exchange market, or the FX market, which is the largest market in the world, it's worldwide, decentralized, it's over-the-counter or OTC financial market for trading currencies. It has no physical location or a centralized exchange like a stock or a futures market, for example, and the volume each day has more than about $5 trillion that may be exchanged. This number gets thrown about all the time, but that's, I think, one of the latest numbers. The total FOREX trading volume is well over 3 times the total of the stock and the futures markets combined. So, essentially it's a very large market. Forex trading is obviously the act of simultaneously buying one currency while selling another, and currency values rise and fall against each other due to the many factors in demand and supply. And some of these things are including your core economic data of every country, things like your GDP, your CPI, your inflation, your rates and employment and labour market data, your overall monetary policy set by your central banks, interest rates exactly, a topic that's very widely watched at the moment with the Federal Reserve and Janet Yellen, and also government intervention. Now, directly into the FX market. Nobody likes to talk about this, but it does happen. They try to control its competitiveness. And look, the most recent example has been the Euro Swiss in January 2015. That's what comes to mind very quickly. That they do get involved in the markets per se. And of course, don't forget geopolitical events such as war and natural disasters, foreign relations, which never seem to run out. And although most of these only really matter when they get close to the markets, like, for example, the Ukraine crisis, it's just such a long gone concept at this time, but when the Ukraine crisis was on, the German GDP numbers and production numbers were getting buffeted around, obviously reflecting on the euro, as well as other sort of general political events. Now, these are the most liquid and most traded currency pairs. They are commonly known as the majors. They also have very common nicknames in the industry. Just so you know, obviously the dollar of the United States, called the greenback, it is undoubtedly the biggest driving force of the world. Whatever the dollar does, the rest will be influenced and be pushed around by. And essentially, since the US interest rates are back from the dead, as you might say, that's also a very influencing factor. The euro, or the European Union member states, they said back in 1999 it was a wild ride. It was probably destined to fail, and with current events, it's definitely under pressure. But it is one of the most traded currencies in the world, the most heavily volume in that. Now you've got yen, which is the Japanese currency. Now the yen, many people don't know, but the Japanese are actually the largest retail group of traders of their currency. This mainly started from a home-based trader known as a Mrs. Watanabe. She was a 60-year-old housewife who made about $8.5 million trading FX, and in particular the yen, from 2000 to 2007. And when it became known, she led to the rise of the hedge fund housewives, where literally hundreds of thousands of retail investors trading away. Now you've got sterling, the Great British Pound, or cable as it's known. In case you didn't know, the term cable dates back to its origins to the 19th century, when the exchange rate between the US dollar and the British pound was transmitted across the Atlantic, and yes, no surprises, by a large cable that ran across the ocean floor. You've got the Swiss franc, or the Swissy. Traditionally, the Swiss franc has always been considered a safe haven currency during geopolitical unrest, and is closely correlated with gold. You've got the Canadian dollar, which is called the loonie, referred to the loonie because of the image of the common loon. It's also well known in a bird in Canada. You've got the Kiwi. The New Zealand dollar, of course, derives also its name from the national icon, and it's also a flightless bird. And of course the Australian dollar, no more need to be said there, except the fact that we abbreviate everything as the Aussie. So some of the advantages, to run quickly through them, as you can see with the FX market, it offers to traders of all levels. Obviously Forex investing offers some of the best risk reward opportunities. You know, the Forex market hours are almost the most flexible of any financial market, with a 24-hour market basically following the sun around the world, starting in New Zealand on Monday morning and finishing in the US at the end of that session early Saturday morning, or the next day. You have really minimal insider trading. No one really can corner the market. It is extremely difficult to even try to, let alone have the pockets deep enough to have an attempt. But the only noticeable exception, of course, was Mr. George Soros and the Quantum Fund, which took a massive short position in sterling, was able to hold it until the market turned and paid out a massive windfall. I think in Britain, called Black Wednesday. It was September 16th in 1992. It was known as the day that the speculators broke the pound. But they didn't actually break it, but they did force the British government to pull it from the European exchange rate mechanism. Now, Forex trading has among the lowest startup costs in terms of money and ease of access. And I mean, some brokers will even, you can open up an account with as little as $100. So trading, can be profitable from, you can get trading profits from small movements in the exchange rate through the use of leverage as well. Now, traders can actually earn a steady income opening positions and rollovers and so forth, and of course you can actually go long and short. So the stock market, obviously, market in which the shares of publicly held companies are issued and traded either through the exchanges or the OTC markets. The stock market makes it possible to grow small initial sums of money into large ones, and to become wealthy without taking the risk of starting a business or making sacrifices that often accompany to a high-paying career. And obviously the largest, most common known stock markets are the New York Stock Exchange and obviously the NASDAQ. Now, I will mention this one without getting into too much detail. Contracts for difference. The difference between where a trade is entered and exited is the contract for difference, commonly known as the CFD. A CFD is a tradable instrument that mirrors the movements of an asset underlying it. It allows for profits and losses to be realized when the underlying asset moves in relation to the position, but the actual underlying asset is never actually owned. So, unlike conventional forms of stock trading, physical shares, CFDs really enable you to potentially profit whether the stock price goes up or down. And CFDs are obviously a leveraged product. You can place a trade by depositing a small amount of the full value of the position. Now, I mention this because managed accounts, we use these extensively, and it's important that we all understand and have a definition of them. So, you're probably starting to wonder why you haven't started trading for yourself. And look, normally at this point, I normally ask members of the presentation if they've had any experience in trading, or if you're currently learning how to trade. You can sort of give me a heads up there in the chat window. Well, some of you will actually understand that what we're going to talk about next, really. So to give you some more background, I touched on earlier, back in the late 90s as a young, energetic 20-something, I got introduced to trading at first by a university friend. I actually accidentally bumped into them in Sydney CBD, and he introduced me to the trade. He was actually day trading the share price index, or the SPY, which is the futures stock index of the ASX 200. He had a little office in the city, and he was trading all by himself. And look, when I walked into that office, that was it for me. I was just in love with the whole idea. Every minute I could spare, we were putting our heads together trading and analysing the market, drawing charts by hand. And all we had back then was the pager and a phone. So, the futures were still an open outcry down at the old Sydney Futures Exchange on George Street. And now I mean, obviously the next step was I scraped up every single dollar that I could find and managed to fund my first, $10,000 account. Now, during this time, I was educating myself. I bought every single book I could get my hands on. My current library is well over 200 books on the topic, and I just really devoured them. I subscribed to all the magazines here in Australia and the US, totally obsessed. But back then, I was hand-drawing my charts, and my bedroom looked like more of a stationery shop, really. I had rolls and rolls of the stuff. I even had historical charts stuck on the wall, which was like wallpaper. And, I guess some of my flatmates didn't appreciate that, but being inspired by my friend, I also went on to open up a small office on the city outskirts, I guess, because it was cheap rent. But anyway, up until this point, I was living my dream. I was this futures trader. I was running my business with a startup capital of $10,000 and trading as many futures markets as I could possibly stay awake for. I traded the USE minis and the FTSE and the DAX, what have you, and it didn't matter that I wasn't making any money and just spinning the wheels. But taking small losses and small wins really never really getting anywhere. But by about this time, a family friend of mine had heard of what I was doing and took a bit more of an interest in me. And well, look, to cut a long story short, he basically funded me and my trading account to a tune of about $100,000. Now, this is the part of the story which gets the reality check. We had been convinced that the reason why I wasn't making money was that I was undercapitalized, and yes, of course, there was that sort of element, but the answer really just wasn't just throw more money in and get started. The real reason was that I had no trade plan, no idea what actually suited me. I was completely ignorant of risk. I was totally crushed by the psychological impact of trading other people's money. And in the end, I lasted about 3 years living off my trading and basically had the old death by 1,000 cuts. Now, let's just say that my family friend took his less losses on the chin, since he knew how hard I worked to destroy his money, and moved on to another business venture. Now, that was 16 years ago, and since then I'd like to think that I've filled in all the gaps. And I've always been trading, and as a full-time trader today, it seems to be a little bit different story. But the end result of this, and the reason I'm telling you this story, is that I basically learned all on my own how to lose money in every conceivable way, and spent a good part of 16 years doing so. Every time I lost money, I would be starting to read another book, another strategy, another dream. This time it's going to work, on and on and on it went. So now, now I know really what it takes to trade successfully, and you can believe me when I tell you that the reality of do-it-yourself trading can be quite brutal. So there is a whisper amongst brokers that actually, and in some cases it's actually a business model for them. And look, and don't get me wrong, brokers are brokers, and and as the saying, there is an old saying that says, for us it's not to wonder why, it's for us is to sell and buy, and they do serve a purpose, obviously. But there is this 90-90-90 rule, and that is that 90% of traders will lose 90% of their account in about 90 days. Now, that may vary these days, but basically it's expected that most newcomers to the market will lose their money. I was no exception either. And really the next stage, is to begin the journey and start to learn if you choose to push on. Now, obviously not everybody has the time or the setup to just quit everything and have a go at full-time trading. If you're working a normal job, most overseas markets are going to be closed. It's really hard actually working a full-time job and coming home to trade the London Open, for example. And remember, but there are people doing this as their day jobs. They are trading the markets, they're living and breathing it in well-paid jobs. So working and then trying to be a trader and then a husband or a wife or for some parent before going to bed, it really just becomes a fantasy. Now, time constraints really are prompted as a benefit. You can you can trade this 24 hours a day, but the reality is you'll be up for hours, missing out on family time and rest, trying to watch the the charts and practice all your trading strategies. And speaking of strategies, there are literally thousands of ways to trade the market. There are many ways as there are people. That's because it's people who make up the market, so it does make sense. But the problem is finding one. Now, I don't mean finding one that works. Most trading strategies work to some degree. Even some of those black box EAs work for a while. And by the way, there is no doubt you'll get caught up, accepting the search for the holy grail of trading methodologies and strategies and indicators. It is part of the process. What else do you think you're doing when you're staying up so late in front of your computers? But the real search is to find a strategy that fits you, to fit your beliefs, and your beliefs and your feelings about trading. A strategy that gives you the confidence when it gets, when the tough gets going, courage that you need, after you've had 5, 6, 7 losses in a row. So you'll absolutely discover a side of yourself you've probably never knew existed when you start to lose money. You'll very quickly discover your risk tolerance, your emotional attachment to your money and what it means to you. Your approach, you'll probably approach the situation like you have as if everything else you've done in your life up until this moment. And this is the moment you realize that you're not emotionally equipped to be a risk taker, even from the start. And even if you're a seasoned business person or an entrepreneur, it just is a little bit different. When you lose money on a trade after you've done a massive amount of research, you've left no stone unturned, you've spent countless hours, you get a swift slap in the face, usually instantly when you put on the trade when you get it wrong. And if you're half a decent, you've done your homework, you'll at least have a stop loss that gets hit straight away. So, and if you are a complete beginner, you may have left the stop loss out, and now you're in a never-ending session of pain between yourself and the market until you can't take it anymore, really, when the market's going against you. So, look, trading is hard because your profit and loss is in your face immediately. The truth is hard to accept for most people. You need to train yourself to accept that, or you will feel somehow cheated by the market, or worse, if you start blaming everything or everyone, except for yourself. So it takes courage and an emotional intelligence to accept that you and only you are accountable for and responsible for your results, and there's no excuses for that. Of course, this is in stark contrast to what the brokers and educators will say or profess. They have a vested interest in your participation, either whether you win or you lose. And having said that, it's not the broker's job to ensure your success. That's your job. But I do think there are a few educators that have a lot to answer for. I think there should be, a holy grail to find a good educator these days. But believe me, I'm almost embarrassed at how much money I've spent over the years on courses and programs. So I can tell you with all honesty. But look, let's just have a quick look at some of these trading rules from great traders. Undoubtedly, W.D. Gann was one of the most famous traders alongside Jesse Livermore. These gentlemen have been recorded in history as the greatest traders that ever lived. They were almost modern. There are also modern traders, but these guys are the pioneers. And you probably can't see, but just reading some of those, you can see how diverse some of the trading rules can be. Although many rules have some things in common, like always use a stop loss, but others include always trade at the market, never trade at the market, always use pending orders, never chase the market, breakouts don't work, enter on retracements, and breakouts are the only true price action, never be scared to buy high prices or sell at low prices. It really never ends. The complexity is amazing. And the important point here is that it's not as easy as it looks, and it's not definitely a get-rich-quick business. Now, an important part that comes to mind is really retail traders versus professional traders. Amateurs in trading is no different to other pursuits. For example, like golf, it's a great sport, and like any other sport, you might think you need the best equipment. You might, you need the best clubs, the clothes. You might even get the buggy. But if you've spent a lot of money on this, then I think you may have missed the point. And it's really not about the gear that makes you better. It's the mindset, it's the experience, it's the practice and the practice and the practice. And trading is no different, really. Beginners look at too many monitors. The indicators are mostly lagging. By the time the triggers a signal, it's probably too late. A chart like this is just confusing. You just need you need clarity for trading, and not this sort of information overload. And some of you might be smiling and being guilty of trying to work with a chart like this. I know I have. Information overload also leads to overtrading, which is also another massive pitfall. So as I mentioned earlier, there are many educators out there, and most have a few good points to offer. Some might actually offer things that work, and unless they have a psychology or a self-awareness component, you're just really wasting your time, because you have to have a psychological fit with the product, or it's just not going to work. You have to own it, as they say, and develop it under your own. This takes time. And the difference, I believe, in home study education courses versus a professional training is really, it's almost like the blind leading the blind. Most of these guys have never traded in a professional environment, and if they have, if they claim to have, you just never know. But their product will be a shadow, trying to recreate something outside of the expertise that they had in the job. So, again, a lot of these guys are sometimes, sort of simply trying to, earn a living from selling a product or a program or a subscription to replace a career that's, changed or ended. Professional traders that I know don't sell education. They trade full-time, they make the returns, and they attract the funds to them. And I get that some might be willing, fulfilling some philanthropic exercise, but they really are very rare. I only know of a few. So professional training, or professionals receive training. They undergo a progression, they get supervised and tested, and there is a huge difference between given a set of rules or a system and then being unleashed onto the market, as compared to being mentored as part of your job, have the experience guiding you, or, have someone with experience guiding you, as you gain your own experience in real time as your day job, and that's your sole focus. And this is why there is a fundamental motivational difference between a retail trader and a professional trader. Although both look at the market and they say they want to make money, the amateur really thinks about doing this by doubling their account quickly or for additional income. The professional trader wants to compound the account from sustained and consistent returns, and because they get to trade larger amounts. Now, their objective obviously is never to risk so much that they might be taken out, whilst the retail trader, knowing, or actually sometimes most unknowingly, accept that risk and does risk more than what they should, normally with disastrous results. So, at this point now, you're probably thinking, well, is there a better way to trade the markets? Having been given all the information, all the tools, you can see how easy it's perceived to be. The reality is sometimes a little bit different, and really the answer to that question is yes, there is. And if you've traded before, or you think you'd like to start, or you've had some learning, you've probably related to some of the points I've mentioned. But again, you've got to ask yourself, well, I'm going to ask you, why are you doing this? If you're a business owner or a busy professional working in your career or in a chosen field, do you really think that trading part-time is the answer, other than an interest or a hobby? Let's just get back to basics and be honest. This is about making money, pure and simple. And there's nothing wrong with that. At the end of the day, we all have our different motivations and definitions of success. But I'm pretty sure that the majority of us would like more time with our family, fit in some more time to pursuits that give us pleasure. So acknowledging that is important. And when you need something done, you find a person who's dedicated. You find a specialist, you find a person whose whole sole occupation is to produce the results in that chosen field. So as far as investments and trading is concerned, market professionals are the people you want to find. So let's have a look at professional management and why it might be a good solution for you. So why use professional management is really the question. Risk management and rules-based trading strategies. Now, we saw previously some rules. Professionals have used rules in order to create some order in the chaos, because trading has no rules or fundamental laws. But in order to produce a consistent result, now that's different. They've done the homework, and that's a key part of being a professional. Risk management is extremely important. It is the basis for the whole game. If you blow this one, you're out of the game. It's as simple as that. The bigger the ignorance, the faster you're out. And professionals don't risk for the sake of it. They have technology-driven execution and proprietary trade management. Now, professional traders use in-house software, risk management engines to statistically measure their results and monitor their trading. Now these programs can be very expensive and mostly a private intellectual property. Now, trading businesses have consistent and planned trading activity. Trading in hedge funds and proprietary trading firms approach the market as a business. And like a retailer of goods, you open your store every day, well, traders are trading every day. They may not be putting on trades, but analyzing price action, working through the mountains of information in order to execute trades instantly when opportunities do come up. The technology in the back end to automate these processes can be quite breathtaking and very modern. So experienced professionals with time in the market. Now, the real difference is that a professional trader has more market experience. They've seen every type of market, every pattern, crash, bubble, rally, what have you. It comes with the territory from when you've been around in the trenches, as you might say. And of course, these businesses are 24 hours, some of them trading, over the 24-hour markets. They have shifts and rotating staff. Now, I get asked this a lot, and I always like to throw this in to give you that perspective. Why is it that professional traders trade derivatives, and why do they trade the FX market? Obviously, every professional trading business, they must have an exposure in the FX, especially if they're on a sort of macro sort of trade plan. The FX market is obviously the largest, most liquid, in the world, as we discovered earlier. It is the trendiest market, and I say that, even though it's very fashionable these days to trade the FX, but what I mean here is that it's that the currencies do trend, and when the FX markets get going, they really move. It can be really exciting sometimes to see some of these moves and trade them, and it really gives professionals a huge profit potential over the long term, and it allows traders to manage the risk. Now, it's also scalable and unlimited. Being able to really adjust trade size is very important, but some opportunities are better than others. But of course, if you keep growing your account, the bigger the potential, and it is truly the most unlimited business that you can be involved in if you know what you're doing. Now, professional management bring regulation, compliance, and accountability. And to bring this home, all Jade Capital products are managed, and managed accounts are regulated and compliant with Australian Financial Services Licence. That's our number there. In Australia, all companies conducting financial services must have a license. They must be registered and audited, and we have many responsibilities to make sure that we conduct the business both ethically and within the guidelines of ASIC, which is the Australian Securities Investment Commission. Now, we're also a member of FOS, which is the Financial Ombudsman Service, providing external dispute resolution for the industry. But basically, it just says that you have rights. If you feel you've been misled or given the wrong information, you can complain, have the matter investigated. All AFSL holders must be members of a third-party resolution service. Now, our performance results are also verified by an independent third party. Professionals are accountable to their trading results, and this means that they are real and they are checked, which is also a very important point. Now, at this stage, I'd like to just introduce the idea of how all of this has come about. Managed accounts have really developed from the need of investors just demanding more control over their funds. Originally, investing was in the realm of the professional bankers and financiers. You entrusted your money to them; they would make a return, take some of those returns, and charge you a management fee. Your funds were, pooled into a larger fund, and you are effectively buying units into that that give you your money value. And this is probably the current setup for most of the superannuation funds if it's not under a self-managed super fund or SMSF umbrella. But as the investing world opened up to the public and technology enabled more access and control, things like newsletters offering trade recommendations and analysis popped up. The natural progression from this was to offer actual trade alerts, detailing what price to get in or out. You obviously had to receive the information in a timely manner, using emails usually too slow, but you have to follow all the recommendations in order to follow the trading strategy to the letter in order to receive the full benefit of the plan. You don't want to sort of only be picking what makes sense to you or what you just came across in time. You might be picking the losing trades and miss the winning ones, which recover from those losses. Now, technology stepped up again and opened up a whole new segment of operators in the trade copier and social trading. Basically here you can just sort of set up your account to copy trades from a list of traders posting trades in real-time platform, and you even get to choose the trades and get the set the level of leverage. Now this sounds like a great idea in theory, but it is so riddled with danger it's not funny. And ASIC kind of agrees and has shut down most of these operations in Australia. I mean, you know, you first have to subscribe, download, install specialized software. You have to open and maintain a VPS, or what's called a private virtual private server. Have a dedicated computer always on to maintain the connection. And because most of these brokers are overseas, you have to send money overseas. I mean, that in itself should be a warning bell right there. But I mean, foreign brokers many times are completely unregulated. This means that you have no recourse if something goes wrong with the trades, or they simply just shut shop and disappear. So, you know, and let's not even talk about the traders being completely unverified, most likely some home-based amateurs with no real industry experience, and more importantly, you know, they have no understanding of risk and producing some exciting returns, but of course unsustainable risk levels. They usually sort of disappear, blow up spectacularly. You know, you've really got to ask yourself, are you really going to follow these people? So up until this point, the main point has been that you as the owner have had to make the decision on whether you take the trade or not. The decision has been yours alone. And we now move on to managed accounts, where the decision is now not yours, even if you agree or not, or even if you know about it. Now, originally in Australia, managed accounts started more like the American version, whereby they were mainly offered in futures as a way to boost an element of risk on your portfolio, a way of adding commodities and metals, mainly gold as a hedge, but also as a way of increasing returns. Now, these eventually moved across into equities, and I believe they really got shadowed by the explosion of the CFDs, as we discussed earlier. But managed accounts can be what's called IMAs, individually managed accounts, or SMAs, separately managed accounts. And the difference now is that this is typical for equities trading space. You have an investment manager making the decisions on your behalf. These people are now making trades on your account with your money, and now typically the process here is after some consultation with the investment manager, they basically ascertain your level of risk appetite, or you know, what I like to call the pillow test, really. How much sleep do you want to have, or how much risk is going to keep you up at night worrying? So they then form a trading plan based on your risk profile and try to stick to it. But look, in our experience, this also has a major flaw in that the trades, you know, they're based on a mandate as agreed to you or set by your risk profile. And look, traders are traders, and like all good salespeople, or when they see an opportunity, they'll just take it, you know, in their motivation to make money for their client. And sometimes these opportunities could be outside of the client mandate, and this is, it's especially difficult to maintain if traders have you know, a few grouped risk profiles. You know, they would have to basically be locked out of certain markets. Now, we've found in general that client accounts would have you know, the odd gold trade or an FX trade that was the sure thing that snuck in there. But over time, we believe in general these types of managed accounts can lend themselves to straying from the strict client risk profile that they originally started with, and it's just really open to temptation. So now, with the next level there is managed discretionary accounts, which is the basis of what we're talking about tonight. And the difference is that the trading strategies are like an off-the-shelf product. They consist of traders and trading teams doing what they do. It's their trade plan, their way of trading the markets that they trade in. So here, the choice is for you to choose what kind of trading results and risk profiles, and not the other way around. And in this case, the results are more stable and in line with the traders. While some investment managers may be very good, of course, it's always better to let the professional do what they do, however they do it, as long as their performance is consistent with the mandate they start with. Now, this mandate is now based on the company that's offering it. It's their risk offer and their variables. That's their business ethics and standards. Now, it's up to the company to showcase their traders and offer the greatest balance for risk reward. And I believe that this is one of Jade Capital's greatest competitive advantages in the marketplace. So by now, you've probably guessed already by definition, an MDA is an opportunity to have a professional trade on your behalf whilst you retain the ownership. So basically, you allow us to trade your account, your money on your behalf. You can sit back and let us do all the work. Now, the difference between a managed fund and a managed account is that you own the asset. The money or your funds are deposited with a broker, and you can control your money. And that's an important distinction, which we'll cover a little bit later in a few minutes. But a managed or an MDA is an absolute return driven and is not benchmarked. Now, what this means to you is that we will always be looking or always be working towards making money, to be profitable at the best of times. Now, some funds like your big superannuation funds only track an index like the ASX 200 or the S&P 500. They will not look for extra returns. They'll just stay with the averages. Now, we actually have access to the capital markets. The technology over the last decade has enabled trades to be replicated across a variety of platforms, similar to the trade copy as I mentioned earlier, but the commercial versions are much more robust and compliant with business needs. Now, when the trader places a trade on the platform, at the top level or the primary master account, as you can see there, the system then allocates trades down through the accounts to all the individual sub-accounts. This is achieved by specifically designed software widely used in the industry. It's called MAM or a PAM, multi-account managers. It's based on the MT4 platform. So if you're familiar with that, you actually do get a read-only MT4 platform, so you can actually follow the trades in real time. Obviously, we don't recommend you to check this every day, since that would obviously defeat the purpose, but you can check whenever you want to. The trades are allocated proportionally to the account size and the risk management algorithm. So the system will allocate position sizing accordingly. So your managed discretionary account will always be traded according to the correct position size and of your balance that'll allow that position size to occur. And this is based on mathematics. So depending on the trader's allocation of a position size, for example, your account will usually be activated and trades will be placed. Now, this top-down process creates a more level playing field, whereby the trader places a full position on each on the account, and each account will then receive the position size. So, for example, in an FX account, an account with $10,000 would most typically trade a mini or a micro lot, and the pip value would be, between $1 and 10 cents. Whilst an account with $100,000, it'll be traded in full lots, and thus the pip value will then be fluctuating at $10 per pip movement. So you can see that basically the traders will put on their trades and all the accounts will be proportionally allocated. Now, this is what I believe to be the Jade Capital Edge, and that's access to hedge fund traders. Now, it's what we offer as access to top hedge fund traders and the institutional fund managers that trade large funds in the derivatives markets. Now, it's from our directors' relationships, their long-standing careers in the financial services industry that gives us access to these professionals. It's a boutique investment advisory, and an MD operator. We can work together with these fund managers that most other operators don't get access to, and we can pass this access on to you directly when you have an MDA with us. Now, normally everyday investors do not get access to institutional hedge fund traders. Obviously, one of the more obvious entry barriers are funding. These type of companies and these people, they don't accept small bite-sized accounts. And to give you an idea, the wholesale market talking hundreds of thousands, minimum entries, sometimes $500,000 to $1 million to get started. So this is the level that these traders are at. Now, this is relevant, and as you remember, professionals risk very little, and they strive to compound accounts with consistent returns. Now, this can be done effectively when you have larger amounts of funds under management. Usually, only sophisticated investors and family offices are allowed to gain access to these type of funds and their traders. They don't offer these products or funds to retail. They just it's just a lack of products, and more importantly, they're just not licensed to operate at the retail level. So Jade Capital Partners bridges that gap, and we allow hedge fund trading directly into your account for those purposes. Now, it offers also the right investor the potential for higher returns. Now, I think currently there is a big problem with cash. If you do have discretionary cash, what do you do with it? Where do you park it to receive a decent potential return? With bank term deposits, in a low inflationary world are only going to be, they're going to be offering you less and less. 1 to 2% interest these days seems almost not worth filling out the paperwork for. So, and any financial planner, as we discussed earlier, will be advising for a balanced portfolio with a diversified allocation to keep you safe and all that sort of stuff. But a managed discretionary account should be able to be an add-on to your overall investment strategy. And part of that strategy designed to capitalize on those meltdowns and melt-ups of volatility, as we discussed earlier. You can only achieve access to that when you have an MDA in the derivative space. Now, having the ability to have trades being taken for you, long or short, remotely, without your emotional attachment, without your fear or greed to get in the way, and to take the trade and have the risk managed in a way and that if it goes wrong, and look, and believe me, it does go wrong. It's nothing. It happens to all traders. Even professionals have losses. But the difference is that these losses can be recovered through normal trading activity. Professionals have proven trading strategies that have been back tested extensively since their, it's their business plan, it's their business model. So their risk and leverage, is, if any, is very small, and so they never really blow up or lose, things overnight. Remember, their game first and foremost is capital preservation, then performance. And this is why professionals can face high-risk markets by respecting the risk, keeping focus on what's important over the long run. And an MDA will take care of that spare cash in a way that can add value to your portfolio. And of course, yes, it should be small enough for you, for it not to rock the boat. So, going forward, the ability to have an MDA business in different asset classes and to diversify risk, you've got to ask yourself sometimes, how do you keep an eye on all the markets all the time? I have clients that absolutely love trading the Australian stock market. They feel comfortable trading, or long-term trend following probably is a better description for themselves with their SMSF or their investment portfolio. They know that the FX market is very lucrative when you get it right, but they don't want to spend the time and energy putting up with large swings and reversals. The sheer non-stop flow of information and events and the high impacting risk of events like in economic news releases. So they open up an FX MDA and they have us do it for them. Some clients have large stock portfolios. They know that they want to be in for the long run as a family trust, for example. They don't want to be selling anything, so they open up an MDA as a hedge to protect themselves from the volatility. This is a tried and tested strategy most large fund managers use, and you can do that too with the right MDA. Now, I also have clients that once they have tried our MDAs, they have realized how they can actually build a trading business on their own. So if you have more of an entrepreneurial spirit, how else could you possibly employ the services of teams of traders that you might spread across all different asset classes or asset markets? Now, some quick benefits that you can see here. Look, asset ownership, like I mentioned earlier, your funds are not with Jade Capitals, they are with the broker. So it's basically your money and it's your account. You have easy access to your money in most cases within 24 to 48 hours, whatever the broker's procedures are. And they are held in segregated accounts with the top tier Australian banks, which is a very important point, especially considering how many other businesses and brokerages are out there. Now, this is a good one. How's that? Nice for a change. There are no entry or exit fees. The difference between large super funds and mutual funds is that they charge they charge you a management fee regardless if they make you money or lose you money. There are no minimum time requirements or lock-in contracts. You can suspend, deactivate or close your account anytime without any penalties. So if you need your cash for some other opportunity or need arises, you can get your funds relatively quickly as compared to other investments. Term deposits sometimes even need 30 days written notice or you'll lose your 1 to 2% anyway. So there really are some great benefits in that sense. There are no hidden charges, memberships or admin fees. We do have brokerage, of course, for equities and futures accounts. They are covered in detail in some of our information memorandums for each of the MDA strategies offered. There are no brokerage costs in most of the FX accounts. In some cases, FX MDAs do have swap rates paid when you're short, but you also earn when you're long. So depending on the current interest rate and also the differences in brokers. But of course, you can't run a business on no fees alone. We do have the one fee. So that is our performance fee. We are a performance fee-based company. We make our income from our performance in absolute terms. So our performance fee is at 25% of profits that are booked. It is from closed and banked trades, not on open positions or any equity balances as such. These are based on reality. So basically, if our traders are not growing your account, we're not getting paid. And this is really what a performance fee based on a high watermark means. Now, to give you an example, just so we're really clear, let's say we begin with an MDA with an opening account of, say, $50,000, and we grow the capital to $60,000 over a period of time, for example. The performance fee is charged on the $10,000 difference. So that going forward, the account begins a drawdown period. Say the account goes to $55,000 over a period of time. There would be no fee until your account exceeds the last high watermark of $60,000. So in other words, we don't make any money unless you're making money. And unlike any other managed fund services, which continue to charge fees regardless of your account balance or performances. So it is truly a product that allows both of our interests to be aligned. Our traders are highly incentivized to be always looking to profit the account. Now, of course, you've got lots of flexible structures there. MDAs can be opened up in a personal account, or if you want, you can open up in a company account, or what's becoming very popular, if it suits you, it can be opened under the self-managed super fund umbrella, and your MDA can be part of the rest of your investments under that system. Now, very quickly, coming to who we are, I'm sure we're almost at the end now, so hopefully you're still with me. Jade Capital Partners, we're an Australian-owned and operated investment advisor. We provide managed discretionary account trading services across multiple financial assets, utilizing over about 100 years of combined trading knowledge, of course. We are specialists in this area. So, look, we don't pretend to be brokers or offer insurance or any other kind of other business. This is our core business. We were established in 2011 by a partnership of experienced industry traders and advisors with a minimum of 15 years experience. You'll probably get to know that most of our directors have even more experience than that. You'll probably see some of the grey hair. Now, really, the reality of the business is that the directors saw a gap in the market. They effectively offer the link between institutional hedge fund traders and some of their, these are their peer groups and colleagues, and retail investors such as yourselves, for example. So they have long-standing relationships and they have personally worked for many years with each other, and that is a very important distinction in respect to what other operators offer. And it's always nice to put a face to a name. You can meet the team here. This is Jamie Clinic, our director. He's worked in the financial markets continuously since 1994, having traded in Sydney and London and Hong Kong. He's dealt extensively across the board with a broad range of financial asset classes, including futures and derivatives, commodities and what have you. These dealings have encompassed a full range of client types, including his retail, his high net worths, professional traders, bankers, proprietary firms, hedge funds, you name it. Jamie's held lots of senior roles in sales and business development, and he's a very well recognised business manager in the Australian CFD and futures broking industry. Now, Anthony Anderson, you can see down the bottom there, he's our Chief Investment Officer, and now Anthony's been involved in the markets for over 35 years after graduating economics degree from the University of Canterbury. He started his career in New Zealand, funny enough, as an FX trader. But he moved to Australia in 81. He continued extensively to develop his career, covering many diverse, demanding roles. He's been instrumental in establishing overseas offices in Japan and Singapore, and he's held management roles across the board as well, very similar to Jamie. And most recently, his career culminated in the position of a managing director of a US investment bank here in Australia and then in Singapore. So you can see basically that these guys have been around for a long time. And continuing the story, you can see here Mark McCabe, who's our head of trading. Mark has successfully managed multi-billion-dollar exposures in currency, commodities, and credit markets. He'd been trading as a foreign exchange for the Bank of America. He was one of 6 founding members of a driving force behind trading systems and methodology for a tall ship capital management, which brought together senior traders and portfolio managers from some of the largest and most respected funds in the industry, including Blue Trend Capital. Mark's managed basically some of the largest risk books in the global commodities for JP Morgan and Chase. He's also founded MMC Capital, which was one of the few managers selected to make a presentation to the Managed Funds Association in 2006. Mark's had over 30 years experience in institutional trading. So, having managed multi-billion-dollar exposures in these sort of things and in currencies and commodities, but he also developed and refined, more importantly, the Global Diversified Investment Program, which is the signature Jade Capital program that manages our wholesale investment. Now, you've also got David Vassallo. I promise you he's my last impersonality here. David is one of Australasia's leading price analysts. He started his career in Perpetual Trustee in 1978, believe it or not. He moved to Australia's older and most respected stockbrokers, JB Were and Son. And having spent 17 years there, he was realised that he had a lot of skill in price analysis. He had a lot of large brand name clients, including some of the more bigger, banking names. In the 1990s, David's trading ideas and price analysis were involved in some of the largest corporate transactions in Australian history. And in 2003, he started the Market Informer, which was a monthly subscribers of over 700 people for David's trade ideas. He's presented to over 20,000 people in different short course formats in Australia and Thailand and recently in Singapore as well. So he's been a man about town for a very long time. Now, these are our strategies. And we haven't got long to go now, so we're at the end of our presentation. But just to quickly run through, we can have a look at some of our strategy here. And don't worry if you missed too much here. All this information is on our memorandums. They are on our website. They are updated on a monthly basis. The good, the bad, and the ugly, as they say. It's all very transparent. We don't run from our performances. We are quite conservative for these types of markets. Don't forget it's all based on risk and reward. So having an outlandish reward doesn't necessarily mean it's a good thing. And any fund manager worth their salt will tell you too much reward will always mean there's too much risk, which can be dangerous and getting taken out of the game. So it's an important point. You've probably also noticed there that we name all of our products after precious stones. So we'll start off with Pearl. Now, Pearl International Equities, it's our long-short MDA. It is our premier product. It's our longest-running program. These guys have been trading together even before Jade Capital came together. It consists of 3 people. The analyst, David Vassallo, as you met before, and his 2 traders. Pearl is basically a trend-following strategy with no real directional bias. It's based on hedge fund portfolio management to produce returns, both rising and falling markets. It does have predetermined profit-taking levels, so it's always sort of reducing exposure. It's always banking a little bit of money because the trades are split into 3s. It hits break even, they take a 3rd, and so forth. It is a systematic hedge against market volatility, and it does trade the US and the UK stock markets. And it does trade all the big names that you'd like to see, like Google and Apple and America Online and Shell and BP, what have you. So that's neither here nor there, but the main point I want to point out here is something quite unique about the Pearl traders. But during the GFC, if you do notice there on the equity chart, you can see that there's a big dip at the end of 2007. Or just before the 2008 marker there. Now, this is a good example of how a long or short funds can make money in a volatile market. Now, because the GFC started, the traders noticed that they were starting to lose money. Basically, they headed into this drawdown, and they realized that obviously what they were doing wasn't working. So they basically then reversed themselves and they got short on this side of the market and locked in a stellar recovery that you can see there, and then they went on to outperform. So if you notice there on the yellow line, they came back and crossed over again. Now, the traders basically dipped before and then kept going into the carnage of the GFC. Now, that was over a 10-month period, including the drawdown and recovery time. Now, what's really interesting here is that many clients pulled out, they panicked during that time, during this pretty public sort of volatile period in the market, the GFC or the global financial crisis. But this is exactly when you need an MDA to capture the opportunities, to protect your portfolio, to create capital growth in what's considered a risky asset such as derivatives. In my opinion, this is professional management at its best, and you can see it there in numbers. And we have all in the metrics. You have the month-to-month breakdowns and all the statistics. If you're statistically minded, you can knock yourself out. But that's an interesting point to see on how professionals behave under certain conditions, and they can be of extreme benefit to most portfolios. Now, Garnet is our Australian equities long-short MDA. It really does look for investment opportunities in the small to mid-cap sector of the market. Now, this is a very old-school way of trading. It's actually personally headed by Anthony Anderson, who you met before, one of our directors. Now, he takes positions based on his knowledge of the people behind the companies. He meets and greets the brokers. He gets the best insights one can get, and he waits patiently for his bias to come through. Now, this is an extremely patient and disciplined approach because it takes weeks sometimes before a trade comes through. And look, when it does, the small mid-cap stocks, they can be quite explosive, hence why the chart looks like such a, like a big roller coaster there. But it's produced some spectacular returns from year to date. Now, you've got Topaz. Now we're into the FX world. Now, this Topaz, our G10 systematic, is based on expert fundamental analysis. This MDA is pretty much an intraday trading system. It's got a proprietary automated execution. The processes, it's based on mathematics and statistical risk and models. It's quite diversified in strategy, which trades the G10 currencies over the short term. It closes all positions daily. Okay, so essentially it's a breakout system. Its execution is completely automated, meaning the trades are triggered automatically by the system, but manually set by the traders every morning, Australian Eastern Standard Time. Now, it will close out all the trades, winners and losers, at the end of the US session, which is usually 7 a.m. the next day. It's very diversified in its approach. You can have almost up to 15 to 18 trades at any given time. And depending on the volatility of the market, it will capture everything across the pairs and all the crosses. And so when the markets really have a sustained intraday move, the Topaz system is really exciting to watch because it'll just capture all the action. It'll take the hard trades, the ones that you're too scared to take, which usually are the big winners. And of course, because it trades across a lot of pairs, not all of them are winners. In fact, sometimes it does have periods where there are more losers than winners. But this is offset usually by the winners being obviously larger, and in fact it does close out and takes the money. So it'll never have weekend risk, and it basically will just chip away at the market. Now, you will notice at the end of 2015 it had its drawdown due to the US dollar going sideways for an extended period of time, and so this really shows that even though you might have a drawdown, you need to hold your nerve, even as a client, and trust your decision about the traders to come out of it. Trust your decision about taking on a managed discretionary account, because it is considered to be a medium to long-term investment. Now, lastly, Emerald, which is our macro FX account. This MDA also trades across all 27 liquid pairs. The strategy methodology is more of a hybrid or automation and complete discretionary trade management. It can take advantage of market volatility whilst maintaining it and its fluid nature. So the strategy is basically completely opposite to Topaz. It's completely manual in that sense. It's known as the discretionary style. It's based on Mark McCabe's trading. His personal trading plan and his trading team, he will basically take a trade whenever he sees an opportunity. He'll manually manage the trade, which means that he can hold positions for a number of days or even weekends. He might close the positions quickly, sometimes before events or event risks such as central bank announcements and economic releases. He will trade after the event quite aggressively and sometimes capitalize on any other opportunities that come up. Sometimes he gets it right, sometimes he gets it wrong. But the point here is that it's a very controlled trade strategy with an absolute risk management. And you can see really from the chart what a 30-year plus experience can produce in a relatively short amount of time. So having covered all the bits and pieces, now you can actually quickly see if you're wanting to get started, there is a little bit of paperwork, nothing to be scared about. There are a few documents that come your way, including the master client agreement, the investor profile, the statement of advice, the limited power of attorney. All these documents fairly straightforward, very easy to fill out. Really the master client agreement really is just it will just document the agreements on both sides of both parties. The investor profile really is this document really just gives Jade Capital Partners a quick snapshot of your financial situation by providing some basic personal balance sheet, which will determine your suitability to investing through an MDA product. It also provides you to a view your risk awareness. So the statement of advice really comes from the previous two documents. It's an assessment of your personal circumstances as agreed upon by you and Jade Capital, and it is required by compliance law under Australian Financial Services Licence. And it is important to understand that Jade Capital, because we are the licence holders, we do issue SOAs and should give you a lot more confidence in dealing with a professional business. And of course, the limited power of attorney just allows us to trade on your behalf. And of course, the last one is to fund your account through your preferred banking institution. Now, pretty much this concludes everything. There was a lot of information there presented tonight, and look, the main theme is that it's about making money, and in an area that you may have thought to have been difficult or risky. I hope that I've shown a different perspective on how a managed discretionary account can make a huge difference, and also why a Jade Capital Partners product has an edge over others. So if you have any questions, we do have some time. If you still have some headspace, it is late. I do apologize for going a little bit over time there, but if you can just pop some questions if you'd like to. If not, I thank you very much for your attention and your time. I look forward to hopefully speaking with you at some point or hearing from you. And don't forget, if you are interested, don't feel that you or if you are ready, you can always get in contact with us. You can get in contact with me. There's my details down the bottom there. If you'd like any more further information, we can definitely follow up on that sense. You can give me a call anytime. So, okay, lovely. Okay, so yeah, so there are minimum. Brett, thank you for your question there. Sorry, so is there a minimum amount needed? So there is a minimum. So obviously our minimum there for our FX products is the easiest one to get involved in. It is required for 10,000 Australian dollars. That was for Emerald. The other FX product there is also 20,000 Australian dollars to get started. Our other Australian and international equity programs do start at 20 and 25,000 Australian dollars, mainly due to the fact that it has exchange requirements, margin requirements, because those products are exchange traded. Okay, yep, there's another. So Darren, g'day Darren, thank you for being here. Can you use your own broker? So we're basically what we like to consider broker agnostic. We don't really mind any brokers in that sense, but we do have affiliations with all currently brokers. We do have our own brokers. You will be required to deposit funds into the brokers that we provide you for, because obviously through the technology and through the associations that we have with our brokers, you will then deposit those funds into the recommended brokers, because we do have the technology sitting there. And you can also, I mean that's not a hard and fast rule, Darren. If you want, we can talk about that a little bit offline if you like. We will consider all brokers if we do have the funds coming through for your facility there that you'd like. So, sorry, there's one more there. I'm just having a little bit of trouble reading that. Just have a quick look there. So the question is, do I need to have experience in finance to open up an MDA? So Jenny, thank you for the question. Look, at the end of the day, this is a financial services product that allows you to be involved in the markets without you having to do anything. So obviously, if you'd like to understand what's going on, and obviously, when you do open up an MDA with Jade Capital, you'll have someone to manage your account. Sometimes, for example, it might be me. You might be able to call in, express some concern, or if you're wanting to understand what's happening in your account, then of course I can be able to talk you through that. And of course, if you have experience in the financial markets, it'll obviously make the whole thing a lot easier. But to answer your question, no, we don't really need. You don't need to have any experience for it because we do all the work for you. That answers your question there. Excellent. Yeah. Okay, Matt. Brexit, of course. We shouldn't forget what's going on currently. So the question is, what will you guys be doing for the Brexit? What's your trades? Okay. So to give you an understanding, look, professional traders don't get involved in these types of markets. This is a binary event. It's extremely unique. If you believe the news wires, it's doom and gloom and risk. It's the end of the world at any given time. So the prospects of being able to efficiently trade is pretty remote. So to answer your question, no, we will probably shut down all trades during this time frame. We'll let all the volatility come and go, and then we'll probably resume trading on Monday because we're interested in preserving our clients' accounts, not really interested in taking on the volatility that comes from these sort of events. So with that in mind, thank you very much for your questions. Look forward to hearing from you, and this concludes our presentation tonight. If you'd like any more information, please contact the numbers, details there. That's my number and email there. I'll probably touch base with you over the next couple of days if you have any further interest, and with that, thank you very much.